Every major recession of the last 60 years made most investors poorer, and made Warren Buffett significantly richer. Not because he predicted them, not because he had information nobody else had, but because he had a specific playbook, a set of moves he executed during every economic downturn, that turned the panic of other investors into the opportunity of a lifetime. In 2026, with recession signals accumulating across multiple indicators, GDP growth slowing, consumer spending softening, credit conditions tightening, and the Fed navigating one of the most difficult monetary environments in decades, the question is not whether a recession is coming. The question is whether you have a playbook for it. In the next 17 minutes, I'm going to give you Buffett's, drawn from 6 decades of documented behavior across every recession America has experienced since 1960. Move 3 is the one that separates investors who survive recessions from investors who build their greatest wealth during them. Stay with me. Warren Buffett has operated through 6 official U.S. recessions since taking control of Berkshire Hathaway in 1965. The 1969 recession, the 1973 oil crisis recession, the early 1980s double dip, the 1990 Gulf War recession, the 2001 dot-com collapse, the 2008 financial crisis. In every single one, the S&P 500 declined significantly. Consumer confidence collapsed. Unemployment rose. The financial press declared that this time was different, that the damage would be permanent, that the recovery would be slow or non-existent. In every single one, Berkshire Hathaway emerged stronger than it entered. Not because Buffett got lucky 6 times in a row, because he had a playbook, and he executed it the same way every time, with the same discipline, the same patience, and the same counterintuitive moves that most investors could not bring themselves to make. Now, in 2026, the signals that historically precede recessions are accumulating. Yield curve inversions, slowing manufacturing, softening consumer spending, rising credit card delinquencies. These are not predictions, they are observations of the present. Buffett's $330 billion cash position, which we covered in an earlier video, is not coincidental. It is preparation. Here is his 5-move recession playbook. The moves he has made before, during, and after every downturn of the last 6 decades. Move 1 is what he does before the recession officially begins. Move 3 is the counterintuitive action that defines how much wealth he builds during the downturn. Move 5 is the move most investors make too late, and how Buffett avoids that mistake every time. The move. In every cycle leading into a recession, Buffett has done the same thing. He raises cash well before the downturn becomes obvious. Not by predicting the recession, by observing that asset prices have risen to levels where the margin of safety he requires has disappeared. When he cannot find businesses at prices he considers attractive, he stops buying. Cash accumulates. He waits. By the time the recession is confirmed, by the time the headlines announce it officially, Buffett already has a war chest ready. The preparation happened quietly, months or years earlier, while everyone else was still fully invested and celebrating gains. Historical evidence. In 2007, a full year before the financial crisis peaked, Buffett was already raising cash and finding few attractive acquisitions. He later noted that by 2008, most of what he would eventually buy was already on his list. He just needed the prices to come to him. This pattern repeated before 2001. Before 1990, the cash accumulation always preceded the crisis, not because Buffett timed it deliberately, but because his valuation discipline naturally produced cash in expensive markets. The current $330 billion position follows the same pattern. It is not a prediction of what is coming. It is the residue of finding nothing worth buying at current prices. What you do. If you are currently struggling to find investments that meet your own valuation criteria, that difficulty is itself a signal. It means assets are priced for optimism. Build cash now, not when the recession is confirmed. By the time the confirmation arrives, the best prices will already be gone. Move 2 is what Buffett does with his buy list during the downturn, and the specific types of businesses he targets first. The move. When Buffett deploys capital during a recession, he does not buy the businesses that have fallen the most. He buys the businesses whose earnings are most resilient, companies that generate consistent cash flow regardless of the economic environment. consumer staples, utilities, insurance, companies that sell products people need whether the economy is growing or shrinking. These businesses typically fall less during recessions and recover faster because their earnings never truly disappear. The businesses that fall 60 or 70% during recessions often fall for a reason. Their earnings collapse, their debt becomes unmanageable, or their competitive position erodes. Buffett generally avoids these in favor of businesses where the recession has created a price opportunity without creating a fundamental deterioration. Historical evidence. In 2008, Buffett's most notable purchases were Goldman Sachs and General Electric, not the most distressed banks, but the institutions he judged most likely to survive and recover with earnings intact. He also bought Burlington Northern Santa Fe, a railroad with stable, recession-resistant freight volumes. He did not buy Lehman Brothers. He did not buy Bear Stearns. He did not chase the deepest discounts in the most distressed sectors. He bought resilience at a discount, which is fundamentally different from buying distress at a discount. What you do before the next recession: identify the businesses in your potential buy list whose earnings would be least affected by a 20% decline in consumer spending. Consumer staples, healthcare, essential services, utilities. These are your first tranche purchases when the downturn comes. Save the more aggressive buying for later, when the recession bottom becomes clearer. Move 3 is the one that defines everything. The counterintuitive action that most investors intellectually understand but almost never actually execute. The move, the peak. The moment that separates Buffett's recession results from everyone else's is not when he starts buying. It is when he accelerates. Most investors who understand the concept of buying the dip do so cautiously and early, at the first sign of a decline. Then, as the recession deepens and prices fall further and the news gets worse, they stop buying. Sometimes they start selling. The fear becomes too great. Buffett does the opposite. He buys more as fear peaks, at the point of maximum pessimism, when the headlines are at their most alarming, when the consensus has shifted from "this might be temporary" to "this could be permanent." He does this not because he enjoys pain, but because he understands the relationship between fear and price. The moment of maximum collective fear is precisely the moment of minimum price, and therefore maximum opportunity. The two are inseparable. Historical evidence, the definitive example. In October 2008, the deepest point of the financial crisis, when Lehman had just failed, when money market funds were breaking the buck, when the Fed was conducting emergency interventions daily, when the financial system appeared to be on the verge of complete collapse, Buffett published his famous New York Times op-ed. He was buying American stocks with his personal money. At that exact moment, the Dow would fall another 25% after he published that piece. He knew it might. He bought anyway because he was thinking in decades, not weeks. And the businesses he bought at those prices have since produced extraordinary returns. The lesson is not that the bottom was in when he bought. The lesson is that buying during peak fear, even before the bottom, produced returns that far exceeded anything available during the subsequent recovery. What you do: create a personal rule before the next recession arrives. When 3 conditions are simultaneously present: quality businesses I understand are trading at prices below my estimated intrinsic value, financial headlines are uniformly negative, and my instinct is to stop buying, that is when I will accelerate my buying, not pause it. Write this rule down. Commit to it before you need it, because in the moment of maximum fear, you will not feel like following it. That is exactly why it must be written and pre-committed. Curiosity gap. Move 4 is about what Buffett does with Berkshire's operating businesses during the recession, and it explains why Berkshire always emerges stronger than its competitors. The move: Berkshire is not just a stock portfolio. It is a collection of operating businesses: Geico, BNSF, Berkshire Hathaway Energy, See's Candies, and dozens of others. During recessions, when revenues fall across most industries, most companies cut costs aggressively, reducing staff, eliminating marketing, cutting R&D, deferring maintenance. Buffett's approach is more selective. He cuts where cuts are genuinely necessary. He does not cut where cuts would permanently damage the competitive position of the business. His distinction: there is a difference between removing cost that was never creating value and removing cost that is building the foundation for the next growth cycle. The first is good management. The second is destroying future earnings to protect current quarter results. Historical evidence. During the 2008 recession, Geico, Berkshire's insurance subsidiary, actually increased its marketing spend while every competitor was cutting. The logic: recessions reduce competition for customer attention. Marketing dollars go further. And customers acquired during a recession tend to be more loyal. They came to you when others were retreating. Geico's market share grew significantly during and after 2008. Not because the recession was good for business, but because Buffett's management of the downturn was better than the competition's. The same pattern appears across Berkshire's businesses in every recession. They emerge with stronger competitive positions precisely because they maintained quality when competitors degraded it. What you do: if you own a business or work in one, identify which costs are genuinely discretionary and which costs are building competitive position. During the next downturn, protect the second category aggressively. Your competitors will cut indiscriminately. The businesses that maintain quality during recessions capture market share that takes years to claw back once the recovery arrives. Move 5 is the final piece, and it is the mistake Buffett has watched investors make at the end of every recession he has ever lived through. The final move in Buffett's recession playbook is the one that requires the least action and produces the most results. After the panic has subsided, after prices have recovered somewhat, after the headlines shift from crisis to cautious optimism, most investors make one of two mistakes. The first: they sell the positions they bought during the downturn too early. They have a 30% gain. They take it. They feel clever. Then the business they sold compounds for another decade and the 30% gain becomes a fraction of what they left on the table. The second: they re-enter the market too aggressively too quickly, chasing the recovery rally with the same emotional energy that caused them to sell during the decline. They buy expensive again. The cycle repeats. Historical evidence. Buffett's position in American Express, purchased during the 1963 salad oil scandal, a mini-crisis, he held for decades. His Coca-Cola position, purchased during a relatively modest market dip in 1988, he held through the 1990 recession, the 2001 collapse, and the 2008 crisis without selling. The pattern across every recession: Buffett buys during the fear, holds through the uncertainty, and collects the full compounding of the recovery. He does not take profits at the first sign of recovery. He does not rotate into the next thing that looks cheap. He holds the positions that proved their quality during the downturn until the underlying thesis genuinely changes. This is perhaps the hardest discipline in the entire playbook. Buying during panic is uncomfortable, but holding through recovery, resisting the temptation to lock in gains, to rotate, to feel clever, is where the real wealth is ultimately generated. What you do: for every position you buy during the next recession, write down your sell criteria before the recovery begins. Not a price target. A thesis change. What would have to be fundamentally different about this business for you to sell? If the answer is if the price doubles, that is not a sell criterion. That is profit-taking. And profit-taking on great businesses bought at great prices is the most common and most expensive mistake in long-term investing. Hold until the thesis changes, not until the price rises. 5 moves, 6 recessions, 60 years. The same playbook executed with the same discipline, producing the same result every time, not despite the recession but because of it. Move 1. Raise cash before everyone else realizes why. Let your valuation discipline do the work. Move 2. Buy recession-resistant earnings first, resilience at a discount, not distress at a discount. Move 3. Accelerate buying as fear peaks. Maximum fear is maximum opportunity. Move 4. Protect operating businesses, never cut what builds competitive position. Move 5. Hold through the recovery. The thesis change is the sell signal, not the price rise. Here is what this playbook reveals about Buffett that goes beyond investing. He is not a genius who predicted 6 recessions correctly. He is a disciplined practitioner who built a system that works regardless of whether a recession comes or not, and that generates extraordinary results when one does. The system does not require predicting the future. It requires building habits of thought and investment discipline that are robust across every economic environment. We have now covered 9 videos in this series: Buffett's rules, his mistakes, his market playbook, Munger's mental models, Dalio's all-weather framework, the Apple decision, Lynch's 10-bagger signals, Mark's second-level thinking, and now the recession playbook. Every one of these investors is different. Different styles, different temperaments, different asset classes, different time horizons. But they share one thing. They all built systems that work when emotion says not to follow them. That is the thread. That is the edge. And it is available to anyone willing to build it. Thank you for watching this series. The next video is right here.